Hello everyone, and welcome to the live stream that we're having today, Onevest in partnership with General Assembly. We're going to be talking about how to found teams and then how to fund your startup. And we have as hosts myself, Alejandro Cremades, CEO at Onevest, and then as well Shahab Kaviani, CMO at Onevest. So myself, the background is illegal. I'm actually a recovering lawyer, still seeking therapy. I was involved in one of the biggest investment arbitration cases in history, which was Chevron against the government of Ecuador with $113 billion. And I saw that there was a big lack of structure in the seed investment arena, and that's when I decided to tackle this problem with my co-founder, Shahab.
Hi, my name is Shahab Kaviani. I was the co-founder at Co-Founders Lab, which is the company that merged with Alejandro's company, an equity crowdfunding platform, Rock the Post, to create Onevest. Prior to founding Co-Founders Lab, I was a co-founder at HyperOffice. It's a cloud collaboration software company, and which had a small exit. And over the years for Co-Founders Lab, I've raised over $800,000 for the startup, and a portion of that came through equity crowdfunding, which I'll be talking a little bit about my experience with that today. We are also going to be taking questions through the chat, so please go ahead and type in your questions, and we'll be answering them towards the end of the broadcast. So quickly, we're going to go through today's agenda. What we'd like to cover is building high-performing teams. So when you're building your team, what should you look for, and where should you look to find co-founders? We'll talk about raising capital for your startup and the pros and cons of using equity crowdfunding for raising capital. And then we'll close with enough time to hopefully answer most of the questions towards the end. So what are some of the benefits of having a co-founder? Well, for one, you need the moral support. I'm going to open with that because I think that is the benefit that's talked about the least. Building a company is extremely stressful. There's been cases of suicide out there, people who've had really tough times with this. This is not something to be taken lightly. It's a big challenge, but it's also incredibly rewarding. And every day you're going to go through some battles, and you're going to get all scraped up, and that next morning you got to wake up and go back at it again. And your co-founder is there in your corner to give you the confidence and optimism to keep fighting for your dream and building your startup. So I would say having at least one co-founder or more is really important for the moral support and getting through all the adversity you're bound to be faced with.
So to that point, actually, Shahab, that's such an amazing, valid point that you mentioned there. It's a roller coaster of emotions, really, what you go through when trying to build a company. I would say that 95% of the days, unfortunately, they are dark, and that's why the 5% you need to really celebrate them like it's the biggest party of your life. But at the end of the day, it's really having someone that is going to help you get through the process, no, and someone that is going to be complementary, no, that has some types of skill sets that you are actually lacking, and that all together put in one make something very, very magical. No?
Yeah, and we've been lucky to find that combination between Alejandro and I and our other co-founder Tanya Prive. And we help each other every day through the challenges of building a company. The next benefit is the sweat equity that you get. So most of your founding team could go out and probably make 30, 40, 50% more money getting a regular job, but you're getting sweat equity into the company and also the capital. So when I started my last startup, actually Co-Founders Lab, my co-founder and I put in the first dollars to get us through that first year before we went and raised outside capital. And then there is the social capital, the networks that you benefit from. So for example, Alejandro and I are right now raising capital for our startup. And we have different investor networks. I have a bigger investor network in Washington, D.C. and San Francisco, where Alejandro has a better network in New York and overseas and in other cities. So you can immediately compound the network effect by having co-founders, and that's not only for raising capital but also finding talent. In fact, we're going on our 1.5. We have one hire and maybe another one that came from a previous startup that I worked on. So the network effect can really be powerful. There's also your advisors that you can draw into. So we brought in Barbara Corcoran, which Tanya Prive, our third co-founder, had a relationship with to be part of the company.
Yeah, so to that point, actually, Shahab, I would like to mention that it's interesting the entire process. No, I think that you were mentioning and talking about equity and compensation and how much the founders are putting in. I would like to throw a personal recommendation to all the people that are watching us right now, and I would say that don't start a company to become a millionaire. Start a company because you're trying to resolve a critical problem and because you want to make a difference in people's lives. Otherwise, it's just going to make no sense. Just wanted to put it out there so that people, write that down.
Thank you. And going back to the slide here, the last area is, and probably the most obvious, is the complementary skills. So the human capital. You want to have people who really enjoy doing or accelerate at the areas that they enjoy performing. So someone who's good with numbers, someone who's good at design, someone who's great with product management, someone who's great at recruiting customers and getting investors. So Alejandro, I would say, is really fantastic at recruiting investors, explaining the vision for our startup, and we complement each other really well. In the early days, we actually went through and literally wrote down on a piece of paper, here's what Alejandro's good at, here's what I'm good at, and we really started to see there's a lot of complementary areas, and you want to build your foundation and cover those key areas. And the best way to get good at this is also do the more uncomfortable part, which is recognizing and being true with yourself about what your weaknesses are. So I personally can't stand dealing with numbers and finances and so on. And we have you want to be able to have someone on the team that can do that.
So, for example, to that point, I'm not good at organizing parties. Shahab is does a great job at it. But now, being a little bit serious, I would like to say that it needs to be very complementary, right? I think that you need to avoid micromanagement in the startup ecosystem when you're trying to build a company. You need to build that sense of trust between your team, that people that are going to be pushing things forward, and I think that's very critical, no?
Great. So next, I'd like to talk about where to find co-founders. Now we've talked about why you should have a co-founder and the importance of having a co-founder. And we are talking about high-scaling companies. We're here to talk about startups. We're talking about taking outside investments, and it's critical to have a founding team. Most professional investors, and particularly the accelerators, are not bringing on single founders. The statistics show overwhelmingly that 2 or more founders are much more successful than single founder companies, and most of the big brands out there are 2 or more founders.
And I would say that investors, for example, they really take a close look at how many founders are actually involved, because if they just see that there's one person involved, they probably say, well, maybe he was not that good at convincing other people to join him. Maybe he's not good at telling the story.
Yeah, absolutely. I mean, there's all sorts of litmus tests that the investors are looking for, and they're looking at traction and website visitors and Twitter followers and customers and so on. But perhaps one of the most telling one is convincing another human to leave their cushy job and take a risk and join you and your company. And that's a testament to the idea and you as a person. So now that we recognize the importance of having a co-founder, where are we going to find them? So a few good places to look at is Co-Founders Lab. Right now is a free service. It's the largest online community of entrepreneurs, one of the largest, with about 45,000 entrepreneurs, all looking to be part of a startup. In addition to the online format, you can go to events that are held in about 40 cities around the world and attend these events to find your co-founder. Another great place is Startup Weekend. There are over 190 cities where there is a Startup Weekend that you can join. These are a 48-hour event where you can meet like-minded people. And what I really like about it is sort of a pressure cooker to hash through ideas, figure out who is going to play what position in building the prototype and pitching that company. And it's a lot of stress to try and get so much done in a weekend, which I think is great because that's where you can really start to see the true colors of someone and which you need to know early on. In addition to the some of the more formal places, Meetup has meetups all around the world. So if, let's say, you want to build a company in the clean tech industry or e-health industry, you can go to a meetup around that industry and find other like-minded people. And there's probably some entrepreneurs that want to be part of a new business. And other places where entrepreneurs hang out, General Assembly, co-working spaces are another great recommendation for where to find co-founders. So now that you've found some candidates, what should you look for in a co-founder? Well, we talked about compatibility. You want to look at the skills, and you want to be in the same industry. You want to probably be within driving distance so you can really build that rapport ideally. And the skills are sort of the most obvious thing that you're going to be looking for, but skills can be learned. You can take a course at General Assembly if you need to learn design thinking. You can go to Founder Institute if you want to be a better founder. But what we're talking about in the personalities is your what we call the Bossy assessment, which is from a company in Chicago. Some smart PhDs built this body of work, and we've licensed this and made it available for free to you on the site at Onevest. And you can take this assessment to identify if you're a builder, an opportunist, a specialist, or an innovator. So Alejandro took this assessment, and he ranks really high as a builder. That means he can articulate a vision, very good with investors, managing investor relationships, where I'm more on the opportunist and innovator side. So I can, create, innovative solutions, out of the box thinking to tough problems. I'm really good at building business models, sales, marketing channels, finding business partnerships. So the opportunist is comfortable going out in the field and trying to drum up business for the company and creating business customers.
So I remember actually when we went through a merger, and I'm sure you remember, Shahab, it was not a long time ago. We did this exam, and it was like going back to high school, at certain degree, but we were very surprised that certain quadrants here were covered by our team. But then, if for example, any of you would go ahead and try this thing, or, maybe, you're trying to find the complementary skills, if you find that part that is lacking, perfectly well that, where is that area where you need to cover the hole. At the end, startups is all about covering holes and resolving problems. And obviously, building your team is one of the biggest problems that you have ahead of you.
Absolutely, and the exercise that Alejandro was describing, we ended up doing it beyond our founding team, which I think is also helpful when you're such a small team. We're about 15 people, and so another key role is the innovator. This is usually the mad scientist. They have a bunch of ideas on their whiteboard. They're very creative thinkers. They're very resourceful, and they can kind of come at a problem from another dimension that you wouldn't have thought of. And that's why I think having diverse teams is really fantastic, because you can, if I'm from the software industry and I have someone who's from the life sciences industry, they're going to look at a problem very differently, and maybe to slice right through that problem where I'm banging my head up against the wall and kind of, can't get through to it. So a diverse team from different industries, different cultures. This is the toughest part, is getting through, trying to work together when you are so diverse, and being able to work with people who are level-headed, and we'll talk about that in a minute. But you've got builder, your opportunist, your innovator, and your specialist. And your specialist is the person deep in that industry. So let's say you're doing something in mobile payments. You want to have somebody who comes from either mobile or the commerce side of the business that can really understand the landscape and helps build a great product. And again, this assessment is available through Onevest or through cofounderslab.com, and you can categorize yourself, and there are videos that explain these concepts a little bit better in more detail. So what are some of the important things that you should have in common? So we talked about how you complement each other, but what are the things they should have in common? Well, I would say having a very strong foundation of trust. We should be getting to know each other's families. We're going to go through battle together. It's going to be very stressful times. A big customer is going to cancel on you. An investor is going to pull out. You're going to go through personal tragedies, and you want to build that foundation of trust that at the first sign of adversity, someone doesn't throw up their hands and say, "This is too tough. I'm not going. I'm not going to see this thing through." And so building that trust is really, really important. Alejandro and I met each other. I was coming up from D.C. To New York. He was coming down from New York to D.C. to meet with me. I'll never forget, Alejandro, when we met in Philadelphia. We had to make a pretty important commitment,
right?
And it was on Easter Sunday. We had to convince our loved ones that we were going to get on a train, and we met exactly in the middle. We went to...
And Shahab calling me at 12 a.m. But anyways, it was like love at first sight, right? And they say that co-founders is like marriage without the love, but I think we did feel the love, at a certain degree, obviously. And but yeah, we met in Philadelphia, like you were saying. It was like kind of under the tables because we didn't want anyone to know about this merger that was cooking. But yeah.
And we met in person, and we really got to know each other on a personal level and work through a lot of the vision. What do we want to build? And we talked about the vision of the company 5 years from now, 10 years from now. And one great exercise I would encourage you to try is ask each other or ask yourself, what do you want the company to be known for? What do you want the company to be remembered for? And that's a really powerful, because that is beyond sort of after you're gone, after you exit, what is the values, what is the brand, what is the solution that you want to bring to society? And I think if you're both on the same page for that, that's a really good indication that you can build something great together. You want to work with someone who can have a healthy conflict. Just today, we were here at our headquarters in New York, and we're working on one of the toughest decisions that we've had to make. We're making a big decision, and we were very divergent opinions on what we wanted to do here. But we were very level-headed about it. We didn't let egos get in the way. I mean, there was definitely a little bit of thumping and people getting up, but it was all healthy. There wasn't any personal attacks, and we knew ultimately we were trying to just get it right. And so some people aren't capable of that, and so you want to spot those people early on and just make sure that they're level-headed. It's okay for them to be passionate. Entrepreneurs, we all run really hot and cold, but you want to make sure that you can get through some of these difficulties in a healthy way. And then I would say having accountability. Accountable for your part of the business. Like Alejandro said, you don't want to be micromanaging each other. The reason you have a co-founder is so I can cover this side of the field and you're covering the other side of the field, and I don't need to worry that that's covered. You've got equity, you've got upside, you've got ownership, your reputation's on the line. You've got just as much to win and lose than I do, and I trust that you're going to make a good call. But we need to be articulating and put it down on paper what you're accountable for. I'm accountable for customer growth, you're accountable for customer satisfaction. Whatever those are, get them down on paper, and then ultimately each person's roles rolls up into the team results. What is the company accountable for? Revenue, customers, or whatever your performance metrics are, getting those and articulating that to the management team and beyond.
So I would like to add as well that we went through a very interesting exercise ourselves as a company. Remember, Shahab, we actually went through the values, the culture of the company, which is obviously the art of listening and speaking, more listening. That's why we have 2 ears. But then as well, we all came together with the framework and the roadmap for the mission and also the vision. Where did we see the company, like you were saying, in 10 to 15 years? Because I think that at the end of the day, it's all the legacy that the entire team is living. And I know that we've spoken many times, Shahab, that when we come into this world, we actually live. We're born, we live, and then we die. But the most important is what we make in between, right? And what are we going to be remembered for? So that's why the alignment that we've been discussing is extremely important.
Thank you. So now that we've talked about why it's important to have a strong founding team, what to look for in your co-founder, how to align your goals and your mission and break up this amazingly challenging task that we've signed up for. The next thing you're going to need to do is raise capital, and I think Alejandro is built an incredible platform, a vibrant network of investors, and I'd like to hand it over to Alejandro to talk about how do you raise capital after you've gotten your friends and family and before Series A, sort of in that middle zone. of seed financing, and in particular equity crowdfunding, which we actually successfully used, and I'll try and chime in on that a little bit too.
Right. So basically, as Shahab is introducing, financing, as for example, many startup CEOs that are out there, you're going to be fundraising 24/7, sometimes more active, sometimes less active. But really the process and the way it works, as we see on this slide, is for the early stage, which is where for the most part the equity crowdfunding platforms out there are operating, they tend to focus when after you, for example, with your co-founder have put the money, perhaps you've received a little bit of money from your friends and family, then you would go into a seed round, which normally tends to vary between 250,000 to 2 million and 3 million. Then you perhaps would do a bridge round, and then after the bridge round, you would do a Series A, and that's how the company keeps scaling on the life cycle, where you finally start to engage the venture capital firms. Normally on the early stage, the people that are really going to drive your project forward are going to be angel investors. That's why they actually call them angel, right? Because they are the ones who believe in you when you still don't have the colors of the canvas totally prepared to really transmit the idea and that vision that you want to execute.
And I think the younger that the company is, the more a factor the founding team and the founders are when that angel investors is looking at you. And that's why it's so important to have a track record, or have that vision and the passion, because the younger you are, the more they're going to look at the founder.
And I would like to say as well, Shahab, that normally when you're doing the fundraising roadshow, really, because it is what it is, you're going to get many no's. So that's why you need to have that passion that drives you through the entire process, and to have hearing those no's, it needs to re-energize you and gives you even more drive to keep moving. So as you see, many of the companies here were, at a certain degree one day at a garage actually developing their idea. Many of you are probably at that stage, and they all went through the different cycles. So with that in mind, I would like to actually mention, as we see here in the next slide, that fundraising, it's really telling a story. The earlier you go into the actual fundraising game, the better storyteller you're going to be becoming. Because at the end, for the investor, is really connecting the dots, right? It's not like you're going to all of a sudden meet that investor and right away is going to give you a check. That's not common. It could happen, but for the most part, you're going to be engaging with the investor. You're going to be making promises. You're going to be showing your execution, and then at a certain degree, those dots are connecting, and they're making the investment. So for that, you're actually going to have to prepare a pitch deck, something where you can showcase the story of what you're trying to accomplish, the type of a journey where you want these investors to actually join you. And normally these slides, especially the ones that we are seeing on our platform, are normally 10 slides, where you would get to see the team, which is the most important, the market, and as well the product, and perhaps the traction that you've been able to accomplish, and then as well the amount that you're trying to raise, because sometimes the amount of money that you're trying to raise is really going to either invite or welcome certain investors or invite others. So with that being said, I would like to actually move to the next slide and to really discuss the way in which these early stage financing rounds are structured. So what you normally see out there, or as a founder, you would be raising money via equity rounds of financing or via convertible notes rounds. So basically for the equity, let's start with the equity round. Basically what it is an offering in which there is someone, let's say a lead investor, that is establishing a valuation on your company, and based on that valuation, everyone is going to be coming under. I always like to say that finding a lead investor is the toughest part, because just as an example, let's say for example, Shahab prom night, right? If you would arrive to the dance floor and it was completely empty, you don't want to be part of it. But let's say if you arrive and there is people having fun, people joining, it doesn't matter the song they're playing, you want to be part of it as well. So I would say that the lead investor is the toughest part, but once you get that, everything is a little bit smoother. So normally for the equity rounds, there is many negotiations that need to happen, many agreements. Is more costly, obviously, than a convertible note round. But normally what it happens is that you would see these types of rounds when the company is a little bit later in the life cycle. So Moving now to the convertible note. The beauty of the convertible note is, first, obviously, you don't have to establish a valuation on your company, on that offering that you're trying to give to investors. And there is three different factors that really need to be taken into consideration when you're trying to seek some investments. The first one is obviously the interest that you're going to be giving to investors, and this interest is going to be normally accrued on a yearly basis. Then there's also going to be a discount that is going to be applied on the next round of funding, which is for the most part being established by a venture capital firm. And then as well, there is a valuation cap. This valuation cap, what it means is that there is the ceiling that you're establishing as a safeguard for these investors. And on the next round of funding, which would be essentially a venture capital firm, that valuation for the investor that is actually going to be converting into equity is not going to go over.
And these three terms, and there's many more, but these three fundamental terms around the discount and the interest and the valuation cap. For example, when one of our convertible notes, we did not issue any discounts. So it depends on sort of your negotiation point. If there's a lot of demand from investors, if you're really sort of heating up and your other terms are sort of fair, you don't necessarily, don't all have to be in here. But these are all negotiable, but they're very common. I think a valuation cap maybe is, in the interest are right, the most common to have in there.
And I think that there's always strategies, right? There's always strategies into getting, for example, a lead investor. I mean, you perhaps can give them an advisory role where you get to know each other a little bit prior to them actually jumping in. And there's different ways in which you can actually make things happen. I would like to say that at the end of the day, when you're raising a round, you need to master certain components. The first one is obviously you need to have a lot of strategy involved. The second one is that you need to create the sense of urgency and also the psychology component, right? Trying to understand and to figure out what that person at the other side of the screen, when you're engaging in communications, perhaps they want and feel and so forth. So with the sense of urgency, which I think is critical, people want to be part of the train that is leaving the station, right? Nobody wants to go into that train that is going to be there forever. And you need to create that sense of urgency via, for example, press, via business development deals that you're closing, via partnerships that are going to help to scale the business further, and so forth. So now, as you see on the next slide, the due diligence process, this is the part where you've already engaged the investor. There is already that sense of trust and commitment for one another. And the due diligence process really is the back and forth with asking questions about your market size. Is it big enough to provide an exit to these investors? Normally in the tech vertical, they're going to look for a 10x or so. Then as well, they're going to be asking for the founding team or the people behind that venture. Do they have the right background? Are they going to be able to execute? Are they going to be able to really handle the tough days, like we were saying? No, Shahab, I think that there is a very funny saying from Paul Graham, actually, that he says that the successful entrepreneurs are like cockroaches. There is never a way to really make them die somehow, no? But really, when you're going into the due diligence process, you're always going to be receiving the same questions from these investors. So write them down and then make sure that you know them by heart for the next meetings that you're going to be having. I would say, as well as a piece of advice, if I may, when you are doing the raising funds or the roadshow, and especially if you're going after the venture capital firms, you want to make sure that you're going to be going for the very first time to the firms that you don't really want so much involved with your business, where you don't really see that strategic partnership component behind. And that way you're able to learn, you're able to understand how the game works. And again, it all comes down to the questions that you're receiving and to doing a good job at them. Maybe not at that meeting, but perhaps for the next meeting.
And this takes practice. I mean, you don't want to hear these questions for the first time with your top candidate investors. So you want to really kind of prioritize your target list of investors. And I would say get some practice runs and don't go to your top candidate, sort of cold. You want to go through some lower stakes kind of targets and make sure you cycle through all the questions that you're going to get. You've got good answers for them. And sometimes you may not have a great answer, and that's okay. You can just say, that's something that we haven't thought about. I'd like a chance to really come back and research this and come back with a good answer. Some of the adjustments that I've made in my business have come from investor questions and challenges, and so they can be extremely valuable to your process. And be ready to really weather this. It's due diligence isn't a lot of fun, and it can be, you know, especially if it's your first time, it can be a little bit intimidating. You sort of have a lot on the line, but you need to sort of build enough confidence and exude that confidence that you've got something that they want. And there's two things that investors really respond to: fear and greed. Fear of missing out on a great deal, and greed because they want to make money off of you and your company. And you need to appeal to those senses. And the only way to get that confidence is through practice. Practice with your friends, with your colleagues, with some of the maybe smaller angels, and just do 20, 30 of these practice runs before you get ready for your big meeting.
I agree, Shahab. I think that at the end of the day, you don't want to make up the answers, because the investors at the end, they have the BS detector somehow. So it's all right if you don't have all the answers. They don't expect you to do that. So as we have on the next slide, we're going to be talking a little bit about equity crowdfunding, right? But maybe perhaps we can touch base on your experience, no, Shahab?
Yeah, sure. So at Co-Founders Lab, we had raised a Series Seed. We got some traction, and we ended up moving into a sort of a bridge round. And at that time, there was a lot of talk about equity crowdfunding, and I really wanted to believe this. After all, we had built a community of close to, around at that time, close to 40,000 members. And I wanted to be able to say, hey, I know it's tough to raise money, and VCs are really, further down the line. If this equity crowdfunding thing is for real, we should be doing it. But before I sort of started recommending it, I wanted to try it first myself. So I went out, scoped out the different platforms. I ended up choosing Rock the Post, which is now Onevest. And the reason I chose them was that they really do hand-holding and really get behind you and do the marketing to their investor network. They invited me onto a digital demo day, which I think was the first of its kind. I don't know of anyone else that does these sort of things, where they pick a few companies, and we were one of them, and we got a lot of interest out of it. We cycled through a few dozen, but in the end we got 3 investors, and they were in cities up in Boston, out in Hawaii. We had investors in China that we would have never otherwise found. And contrary to what some people may say, 2 of them are very valuable investors in our company. They're giving us leads. They're making introductions. So we were very pleased with it. And this was all before we entered into a partnership or even explored the partnership. So we tried it firsthand, and it worked. And we began educating our entrepreneurship community about equity crowdfunding.
And that's one of the biggest misconceptions, right, Shahab? I think that people feel that by going online and raising money that you're going to be getting dumb money. But at the end of the day, behind those screens, you have early stage venture capital firms, as well family offices, high net worth individuals, and people that are willing to explore deals. So with that in mind, I would like to first make a big differentiation before we dive into the equity crowdfunding. And crowdfunding, really we have different ramifications so that there's no confusion. On one end, you have the donation-based crowdfunding, where people are giving a contribution, a monetary contribution, and in exchange getting a tangible reward. Then you have the peer-to-peer lending, where it's basically loans with interest on them and with striking date. And then you have equity crowdfunding, where essentially you're receiving shares in exchange of the investment that you're actually making. So with that being said, the beautiful thing about, for example, equity crowdfunding, when you're raising money for your startup, is the fact that the platform that you're going to be working with is going to really take into consideration and view this as a partnership. At least we do. So with that in mind, we do wake up every morning to make a difference in entrepreneurs' lives. So obviously, when you win, we also win. But as well, I would like to say that via these platforms, you have access to a whole different pool of investors that you never had access before. So instead of having to do like the offline route, where you're picking up the phone and calling an investor and maybe him telling you that it's not the vertical or the investment thesis and so forth, now you have the chance to access all these people, because at the end of the day, when they're pulling the trigger and making the investment in you, it's going to all matter on the vertical that you're operating in, the ticket size, the round size, and also the minimum amount to buy in.
And I think one of the really interesting things that it's at work here with equity crowdfunding, and there are sites that do real estate equity crowdfunding. We happen to do early stage, mostly tech companies. And what's really at work here is before you had to go convince someone to write a $250,000, $500,000 investment into your company. Through equity crowdfunding, now that investment may be $5,000, $10,000, $25,000. What does that do? It reduces the risk that the investor has to take. So now that we're seeing this trend emerge, we believe, and we're seeing this now, that access to capital for credible entrepreneurs. I mean, there's no shortcut. You still got to build a great company, build a good product, show traction, all that stuff. But it is easier, particularly if you're not in the hubs. If you're not in San Francisco or New York or Boston, it's very hard to find this capital. The risk that's reduced can really make this much more attainable for entrepreneurs, and that's what we're really excited to see pan out.
Yeah, and I think that a big component here is the educational route. No, I think that right now, for example, we do feel that it's important to explain to people how this works. Not only for the entrepreneur, but also for the investor. And if there are any founders from potential platforms out there viewing us, we do invite them to really push things forward on the educational component, because I think that at the end of the day, the oldest equity crowdfunding platform is probably not even 2 years old. So I think that it's important to make sure that we help people understand what are the differences between different ramifications, and also how we can help people out to understand from the founder perspective how the fundraising game works, especially online, and then as well for the investor side, how everything it works from beginning to end, which is the actual transaction. Shahab was mentioning, obviously now for the investor, it really helps to diversify the risk and to hedge your bets. So platforms like equity crowdfunding platforms, like for example the one that we operate, it really helps in that regard. So with that in mind, I think that we are coming to the end of the presentation, but we do want to have a little bit of Q&A with all of you. So we're going to be receiving the questions here on our end. I'm going to be reading them out loud, and maybe we're both passionate, so we might fight to see who answers them, but feel free to ask anything that comes to mind. So I think that the first question here that we have, and I think this is going to be more for you, Shahab, is when choosing a co-founder, how much do you consider what work you can just outsource?
Sure, that's a good question. And if you can outsource something, I think in the early days, it's better to do that to lower cost. In fact, in the very early days of both my last startups, we started our first versions, offshoring, and even it might be even marketing, whether it's prospecting over the phone or people doing email, social media marketing, where in the places that you should in the early days. But here's the parts that you don't. Anything that is your competitive advantage and is part of that you want to build IP around and is going to be part of your secret sauce, you need to build that institutional knowledge internally, and I wouldn't outsource some of those. So if your product is heavily tech focused and it has to be the best sort of platform in whatever industry, you probably at some point fairly early want to bring that in or start right out of the gate. So I think it depends on sort of how close it is to the core of your business, and whenever possible, some of the least critical or less critical ones that are sort of at the fringes, when possible, I would say try to lower your costs and outsource some of those.
So I think the next question, I'm actually going to take it because I had to deal with it at certain point. And the question is, what do you think about outsourcing and saving on equity? Is it worth it to outsource in that case? So to this question, actually, I would like to say that it's a little bit painful to try to save on that note, because then at the end of the day, you're going to have to bring it in-house. Investors, for the most part, are not going to invest in something that is outsourced. Potentially, there may be some IP problems involved. So you want to make sure that even though it's hard to convince a tech co-founder because they are inundated with choices like we see here, it's important to have them earlier on, because if you outsource and try to save on equity, then the problem that you're going to have later on is that it's going to cost you a lot of money to actually develop it in-house.
And the next question we have here is, do you find that most prototypes are built by contracted developers these days, since technical co-founders are inundated with choice? So technical co-founders are really sort of the, they're scarce, and they have a lot of good options out there, high-paying jobs. So they are hard to convince if you're the business person. I would say before we talk about building the prototype, you can just build a rich media or sort of a high fidelity, interactive prototype where you don't actually build the nuts and bolts and the guts and connect it to a database. Where we're talking about online products, and that's where you can start doing some of your lean, lean methodology of getting out there, talking with customers, having them click buttons, and some of that stuff you can just learn and build yourself. General Assembly has courses like that can help you do that, and lots of places online to learn how to build some of the prototyping. But if you are going to build your first version, you've kind of gotten past that, and you're going to build your first version. Yeah, I think outsourcing that to a firm is perfectly fine for version 1 to get a little bit of traction, and make sure you go to a group that's you've got references. You get to meet them in person if possible, and look at their portfolio and their past successes. But I think that's perfectly fine. And as to do we see more of that than not, I do think that recently, as compared to 3 years ago, we are seeing more people outsourcing their version 1 because there's a huge swell of people who are, particularly with the millennials, about 56% of us. I squeeze myself in there. I'm going to squeeze myself into the millennials.
Squeeze yourself.
So the 56% of millennials want to start companies. There's a lot of people out there like us, and still not, the tech talent isn't growing fast enough. So I am starting to see more of that.
I think that's a good point, Shahab, because at the end of the day, on day one, right, it's going to be very hard to potentially convince that technical co-founder that is a rock star. Perhaps you go with the version 1, you're able to get some press, some momentum, and maybe you can get that person involved, and you have more ammunition to be able to actually convince that person. So the next question that we have, they're talking about the ideal number of co-founders. Perhaps maybe I can give my 2 cents, and then Shahab, you can jump in.
Please.
What I've been, perhaps in my experience, I feel that having under 2 is a little bit of a complicated and a hurdle. We were talking about this towards investors, the message that is actually sending. But if you have 2, it's great. If you have 3, it's fantastic. And if you have 4, and if you go over 4, maybe it can get a little bit complicated, because then you have different types of perspectives, opinions, and then it can get a little bit messy.
Yeah, and I would agree with most of that. 2 is great. 3 is also good. We're currently 3. I think it works really well. One of the benefits of having 3 is if you're sort of at a standstill, you can sort of vote on particular issues. My last startup, we had 4 co-founders, and while we had a healthy company, we were successful, there were definitely moments where I felt like it was too much. There were a few key decisions that took very long because we were 2 and 2. And we were trying to build consensus. So I think 2 or 3 is really the right number.
So the next question is if we think that a co-founder means that you're going to be successful quicker. So we were actually touching base on this, and it is very important to have someone that is going to complement you, because at the end of the day, you're going to have to potentially raise a round, and you're going to have to fulfill certain positions. So if you have a co-founder that have certain skills, let's say a tech co-founder, then you're going to be saving some money on the development. That person, you're going to be relying on that person fully. So I wouldn't say that it's going to make you successful quicker. It might, but it's definitely going to help in the bottom line and in pushing things forward.
Yeah, and we're obviously doubling our speed, particularly when we're first starting out. A lot of us don't have the means to just go for the startup, out of the gate. And we're working on this thing part-time. So part-time, 2 people part-time, you may almost be working sort of the equivalent of 1 sort of man-month, if you will, or at that speed. So I think the additional people, and then 1 + 1 should equal 3, right? It's not only the additive output that you get, but it's also where you're sort of boosting each other, motivating each other, and keeping each other up late at night to work on it. So I think you probably can move quite a bit faster through it.
Right. So the next question is actually they're asking, how soon should you identify a co-founder? My opinion is that as soon as possible you can convince someone on the street, but I don't know what would you like to say to that, Shahab?
Yeah, I mean, you're in the early days, you're sort of socializing the idea, and through that socialization process, you may find someone. But as soon as you start to get that validation that this is something that is worth pursuing, I think that's almost too late. And so I'd say generally the earlier the better. Maybe not too early where you sort of haven't validated the idea. You kind of want to get past the first inning, but I'd say generally the sooner the better.
Right, that's a good point, Shahab, because actually the issue here is that ideas are just ideas, right? I think that what Mark Cuban says is that when you have an idea, there's at least 100 other people that have thought about that same idea. It all relies on the execution. So that's why when you have an idea, it's going to be full of holes, and when you get that chance to actually brainstorm with someone else, it really makes a difference. So with that being said, we have here another one. How do you deal with the initial secrecy when looking for co-founder, and what if you have an idea and you're concerned about someone stealing it? So I think maybe I'm going to take that one because that's the biggest misconception about crowdfunding, right? What happens if you put your idea out there for people to see it? Again, I think that goes with my answer before. It all comes down to your execution level, to the team that you have behind, to how fast you are, to seeing what your competitors are doing, to doing it actually better and so forth. So I think that you shouldn't be, as long as obviously, like there is no patents or IP involved, you should go out there, get as many advice as you can, and really brainstorm with as much people as possible.
And I do hear this a lot more from sort of first-time entrepreneurs than the more seasoned one, but it's a fair question. And I think in the early days you can sort of share enough to generate interest, and as you the more trust you build with that person, you sort of peel back another layer of the onion. And then once you've really kind of gotten more commitment that we're probably going to do this, then you can kind of get into more of the secret sauce. But generally, I think Alejandro and Mark Cuban are right that when you come up with an idea, there's probably a few other people that are thinking about it. All comes down to executing it, listening to your customer, and outperforming anybody else who's aiming at the same prize.
So the next question they're asking us, if the founder is bootstrapping and has over 2,000 customers, if they still need a co-founder. So I think Shahab, I believe he already mentioned and touched on this. When you already have the idea validated, it's a little bit tougher. Perhaps maybe at that stage you want to really form the management team and the people that are going to be pushing you with the idea and covering the holes and so forth. But do you have anything to add there?
Well, I mean, 2,000 is good, but 200,000 is much better. I mean, if you're going to go for something big, you need to have people covering all sides of the field. And if you're going to get VC money, it's very rare that you're going to get it as a single founder. So I think even with the traction, unless you're sort of a fifth-time founder or fourth-time founder, where you're sort of a master of many parts of the business, and you're a builder, opportunist, specialist, and innovator all in one, which is very rare or impossible. I would say even with traction, I would go for one.
I remember actually that story of my grandmother, the saying, even shoot for the moon, and even if you miss, you land on the stars. No, that's the 2,000 to 200,000. Obviously, as long as you're thinking, think big. No, Shahab?
Yep.
So the next question, is it better to produce at least a beta or prototype before approaching a co-founder? So I think that maybe you want to go first.
Sure. Especially if you are looking for a technical co-founder, you need to do everything you can to improve your chances and stand out from the crowd. So remember, they're getting pitched by people with ideas on a napkin, but if you come up and say, here's a prototype, you're going to stand out. Why? Number one, they can visualize that idea a little bit better. So they're actually seeing it and they can kind of get on the same page. Number two, they're seeing that you are investing your own hard-earned dollar and your own time, and that's a very good signal. So I think it is good to get the prototype, but going back to that rich high fidelity sort of demo is also fine too.
Yeah, I think the prototype is important because at the end of the day, and probably you agree, Shahab, really this is like having a canvas. And the earlier you are in the stage, the less colors you have in the canvas. So the more you're able to transmit to that people, to convince them to actually join you, I think is really going to be helpful in that journey. So I'm going to actually let you read this one.
Sure. If you're trying to found a startup while still in a full-time job, does that prevent you from raising capital? No, I don't think so. I think I think they may come to you and say, hey, look, this is the period of time when, these are the milestones or period of time that we expect to elapse or less before we give you more money. But the investor may start small while you're part-time. Generally speaking, you're going to be a lot more successful if you have taken the leap and gone full-time, depending on the size of the check. So if we're talking about maybe $10,000-$20,000, I think doing something part-time is, or having a job is fine. But here's a couple ways that you might be able to get around that. One is you could become a consultant. So you're working full-time, maybe a few years, 5 years, 6 years in industry. If you become a consultant, you can kind of get some side income while you're preparing to make your move. So that's one. I think if you are working full-time, if it's not if it's more of a cushy job, there's a lot of hours in the day, right? When I was working on Co-Founders Lab, I actually was working full-time for a period while I was sort of dreaming up Co-Founders Lab, and from 9 p.m. till 1 in the morning, I was online with Skype with my developers overseas working on this thing. So you can do both, and I think some investors can be convinced if they're smaller investors. But ultimately, once you kind of get a $50,000, $100,000 check, you probably do need to be full time into it.
Right, and I think just to add on that, Shahab, it is very important the life cycle of the business, right? Because if you are, for example, at a friends and family round, let's say it's easier because it's people in your network, they know you. Perhaps having that part-time job, then it's going to be okay. But if you go towards sophisticated investors, the problem that you're going to have is that perhaps they're going to see somehow a lack of commitment. So if they basically see that you're not diving in, why would they dive in with you? So that's the question that they're going to ask themselves. So the next question is, how do you split up equity, and how much should you give your co-founder? So let me go first, Shahab,
sure.
Because I really feel like it is important to share the success. Share the success and not be greedy. I think that is better to have 2% of $1 billion than 100% of nothing. So I think that it's all the people that are behind of the venture, like you were saying, the human capital, and it is important to have that balance with one another, no?
And one of the most common answers is that it's 50-50, and it's almost never the right answer, because that would reflect that you truly are bringing 50-50 equal value to the business. And what I would encourage you to do is try to sort of calculate the value that you bring to the company. I think the idea gets way too much credit. I don't think you can say because I had the idea I should get 5% or 20%. The idea is probably the least of all of the assets that you bring. On cofounderslab.com, there's a resources area where we have some content around this. This will soon be under Onevest. There's a great resource called a Slicing Pie, and the basic idea of this is that you should try to ascribe a dollar valuation to all the assets that you're bringing. So, for example, let's say I'm spending 25 hours a week and the other person's spending 40 hours a week. Then the equity should reflect that. How do you figure that out? You can look at what you were being paid previous to the startup and count the hours that you're spending and put a dollar amount on that. But that's sort of discounted because as compared to a cash investment. So if one of your co-founders is putting in $25,000 and you're putting $5,000, dollar for dollar, that should be reflected, because that's a certainty. The dollar that you're putting in versus the value of your time is a little bit less certain. Maybe one co-founder has a bigger Rolodex than the other. Maybe one co-founder has 10 years of work experience and one just graduated college. Maybe you might have a bigger network of potential customers. And so you want to walk through all of the assets that you need to build the company. What assets does each person bring, and then try to assign a value to those to get you to that number.
I saw a question coming in that was very much aligned with what we were discussing, and they were saying if you are, let's say, a CEO, and you've already thought about the entire idea, but you need that technical person, how do you split? I mean, my opinion is that technical person is going to really build and start to make things a little bit more tangible. So I think that, it's always important to really share the pie, 50-50. I mean, that's really the way I view things in life, especially at the early stage when you're starting to make that baby being born. Remember when we actually co-founded this thing, we were like, can't you believe that we actually were in the waiting room for all this time, remember? That was actually very funny. But let's see, the next question here is, how do ownership shares get liquidated as more funding is raised? So I think maybe I can take this one, no? Yeah. So basically the way it works is everyone is going to get diluted in subsequent rounds of funding, right? Because you are getting dilution on the actual shares that you initially had in the company, but the value of the company is also increasing as you're continuing on the life cycle of the business. So I would say, like I was saying before, it's better to have 2% of 2 billion than 100% of nothing. So yes, you're getting diluted. Yes, there's more people that are coming in and the piece of the pie is getting smaller, but that piece of the pie is obviously gaining more value. So the next question, unless you have something to add there.
It looks like we do have time for just a few more questions. Yeah.
Okay, wonderful. So if I have idea in a field that I don't have expertise, how hard it is to get funds? So I would say that it is important that you're able to surround yourself by people that have the expertise. Maybe you don't have the exact expertise on that field. Maybe you are more of the business development. Maybe you are more of the salesperson. Maybe another completely different skill set to maybe that application, healthcare application that you want to launch. You're maybe not a doctor. So maybe what you can do is you can actually recruit, like we were talking about right now, a co-founder that has those complementary skills and just go ahead and move forward. No?
Yeah, and if this question is asking sort of as a single founder without industry expertise, I think it's going to be almost impossible to raise, because it's just so much risk that you're taking on that could be reduced by betting on someone who understands the industry.
Right. And the next question that we have is, what do we think about revenue royalty as an alternative to equity? My personal feeling here is that the revenue is always the revenue royalty is always going to get cash out of the business. You need that business that money to actually scale the business by itself. If you have equity, you're actually having people that are going to be aligned more with the future, with what you're trying to accomplish, and those goals are more in parallel. So that's my thought.
I think I generally agree with that, but if they are sort of small enough and it doesn't hurt the company as much, because you would have otherwise had to pay that person, then it could work to pay some sort of dividends along the way, maybe for a finite period of time. If you make it sort of unlimited, that's going to be a big bruise on when an investor looks at you. So you want to sort of put some parameters, limits on the period of paying out some of those royalties. But it's sort of like a base versus draw program. If you ever worked in commission programs, you're sort of offsetting what you would have otherwise made through some future royalties. I think it could be a great motivator. So it depends on the position. But I would say if you do go that route, definitely put some future limits on how long that term is.
So it looks like this is coming to an end, unfortunately. Shahab, it has been wonderful to have you here as neighbor on this table. And I would like to really thank the entire team at General Assembly for making this possible. I would like to thank you all for really tuning in. Some people of you from Europe, which is a little bit late at night. Feel free at any point to reach out to us. You can reach out to me via my email, as you see there, alejandro@onevest.com. My Twitter handle is @acromates there, and then as well Shahab.
And my Twitter handle is Kaviani S, my last name and first initial. Happy to hear from you. Please follow us. Follow at Onevest to hear more about other tools and tips that we can put out to make your journey a success. And thank you very much for joining.
Thank you. Bye-bye.